Hi everyone, Kathleen here from XTB. We are doing a market live today as we lead up to some key economic data. So we've got the UK CPI report tomorrow morning. We've then got the US CPI report on Wednesday afternoon, and then we have bank earnings around about the same time as well. So it really is a bumper Wednesday for economic data. Now, we've obviously seen a lot of volatility in the markets as we lead up to the UK inflation report. The pound had staged a recovery earlier today, but it is giving back those gains and it's moving away from that 122 level back towards 121. That's in the cable rate. We've also seen bond yields stabilize, but that may not last for long because we have this inflation report for tomorrow. Now, in terms of what the market are expecting, they're expecting a 0.4% increase in the monthly CPI rate. They're expecting the annual CPI rate to remain steady at 2.6% and for a decline in service price inflation to 4.8% from 5%. So as you can see, a fairly benign inflation report is expected. Now that increases the risk of a nasty upside surprise. So if we take a look at chart 1, this shows service price inflation, or the components of service price inflation. So service price inflation has been quite high, but wages are not having such a big impact on service prices as we have seen in previous months, as you can see here. Instead, it's the wage insensitive side of things, which is the orange bar in this chart. Now, what does that mean? Essentially, it means that rents are what are driving inflation and service price inflation in particular. But you've also got on top of that, companies are now kind of embedding price rises into their their prices, what they're selling to consumers, and that's what's feeding through to inflation. Now, if we take a look at the second chart, please, this shows the pound, which is the orange line in the chart and has really been heading south. At the same time as we've seen bond yields, this is the 10-year bond yield, is the white line in this chart. Now that's been moving north. So they've got an inverse correlation. So when we see bond yields rise, that has weighed on the pound. Now that's led to fears about fiscal pressures in the UK, and we've spoken about that before. What that means tomorrow is that if we see an upside surprise to inflation, that could push up the bond yield. So the white line in that chart could move higher. And what we could see is more downward pressure on the pound. Now, the pound US dollar rate, that is the most traded pound currency cross. And we're looking at that because it's really important, because it is approaching a key psychological level at 120. Now that's worth watching closely. Remember, we broke below that level during the Liz Truss era. But if we do see a nasty little surprise to inflation tomorrow, we could see bond yields rise very sharply. We could see the pound fall further. That could increase a lot of stress in the UK financial system, and it could lead to a fiscal event. Now, that could take the shape of many things, but it could lead to some official intervention from the likes of the Bank of England and even from the government, maybe announcing some earlier spending cuts than what is currently planned, because they're not expected to do that until March. So this is a really important piece of data that's coming out tomorrow. Now, we also, as I mentioned, have the US. I'm going to focus a little bit more on the US now. They have their inflation tomorrow. Again, monthly inflation is expected to rise to 0.4%, but the annual rate in the US is expected to increase to 2.9% from 2.7%. So it's worth noting that inflation pressures in the US are rising, and that's even before Trump has had his inauguration, which is next week. So what we're potentially seeing is, if inflation does increase to 2.9%, it would suggest that the trend of disinflation is over. That makes it less likely to get Fed interest rate cuts this year. And it could also mean that the US, because it essentially means that the US economy is overheating in some way. In that sense, we could see risk sentiment drain from the markets, because remember, Trump is seen as being a bit inflationary with some of his economic policies linked to tariffs and also linked to tax breaks and things like that. So tariffs, he said he's going to take, well, some people in his administration reported that he'll take them a bit more slowly than the market was expecting. That's boosted a bit of risk sentiment on Tuesday, but really it will all come down to this data. This CPI data could really set the tone for markets tomorrow. Higher than expected inflation in the UK, that could weigh on bond yields, weigh on the pound, but stronger than expected inflation in the US. Now that could push up the dollar quite significantly and also weigh on risk sentiment, which could make it a little bit hard for stocks to rally in that environment. We could see a bit more of a sell-off. That could be good news for safe havens such as gold. Now, on top of all of that, we may have some good news tomorrow from US banks. If we take a look at the third chart, This shows the KBW. This is the US banking index. That is the white line in this chart. And then the orange line is JP Morgan. So JP Morgan being the biggest bank in the US. As you can see, it's outperformed the overall banking sector in the US. Now that's worth noting because tomorrow on Wednesday, we have got JP Morgan, Goldman Sachs, Morgan Stanley, and Bank of America. They will report their earnings from tomorrow through to the rest of the week. JP Morgan goes first on Wednesday. They're expected to report a bumper post-election trading revenue. So combined, they're expected to see a 15% increase in trading revenue. Remember, markets went wild after the election of Donald Trump. So that Trump trade is really expected to boost bank earnings. And they're expected to see a combined 24.5 billion increase in trading revenues, which would be the highest for 5 years. So equities, they're expected to do very well. Investment banking expected to do very well. Deal making as well. That's also expected to do well. Now, it's worth noting that in the UK, we don't have so many investment banks, but Barclays is worth noting. So if we see good news from the likes of JP Morgan's investment banking arms, that could be good news for some of the UK banks such as Barclays, which also has a large investment banking arm. Now, net interest income. Remember, we've seen interest rates in the US fall back. That tends to sometimes have a negative impact on bank earnings. So that could be lower than expected, around about that $60 billion mark. It had been about $63 billion this time last year. So we could see a decrease in net interest income for banks. However, they could stabilize in 2025 net interest income because the Federal Reserve is expected to pass back or pare back interest rate cuts. So right now there's only one cut priced in the market, but if we get an upside surprise to inflation tomorrow from the US, then that could mean that all interest rate hike cuts are priced out of the US market. Again, that would be potentially good news for banks, but it could weigh on the broader equity sector. Looking at banks also, we could see having the Trump inauguration, I think we could potentially see some positive outlooks, and that's because Trump is expected to scale back on regulation and also to rule out any increase in capital requirements for banks. So that's also worth noting. So again, we've had a very a volatile week, but things seem to be a bit calmer on Tuesday, but this could be the calm before the storm. Also leading into the rest of the week, we've got retail sales in the US on Friday and in the UK on Friday, and we've got monthly GDP data for the UK on Thursday as well. So a lot to digest there, alongside more debt auctions. So plenty of volatility ahead, and I think it's interesting that the pound is starting to just lose a bit of enthusiasm for a mini recovery as we lead up to that CPI rate. But thank you everybody for joining. I do hope that you found this useful, and please join us for next time. Thank you.